Good evening. Welcome to the ShadowTrader Video Weekly for Sunday, August 18th, 2013. We had a little bit of a rout this week in the markets, falling out of a head and shoulders pattern here, which turned out to be more powerful than all of the little buying up of the liquidation breaks. If you recall in last week's video, which obviously was 5 days prior, so all this down action hadn't happened, I felt that there was good chance that the market consolidation here, which had lasted a number of days, was going to resolve to the upside. That obviously didn't happen. We actually resolved to the downside after creating a head and shoulders pattern later last week, or I should say earlier this past week, and then falling out of it on Thursday, Friday. The action on Thursday, Friday, although if you look at the daily bars here on the S&P, it would seem outwardly super bearish. I don't think it's really all that bearish. I want to get into some nuances here of just how bearish I think it was, and a lot of that has to do obviously with market profile, so I'll put that up here. These are the 2 days in question, Thursday and Friday, so I want to draw your attention to a couple of things happening here. The first of which is that Thursday's action had a liquidation break from the open and did not result in a profile that was elongated at all. When there's a combination of new money sellers and old business, meaning longs liquidating, so selling, and then new shorts coming in, you have a much more elongated profile, and you wouldn't get this letter B formation here. The letter B is more of a long liquidation profile, and the lack of extension, as I was saying. The other thing that I noticed on Thursday as well is that you do have some anomalies, and anomalies are simply where the profile is relatively flat on the edges, and you don't have it nice and rounded how it should be. And you can think of anomalies as forcing action. Essentially what's happening is sellers are selling, but they're kind of being forced to, like they don't really want the market lower at that point. That's the way I look at anomalies, and they're really just indicative of poor structure. And just in the same way that we have poor structure on the way up, you can also have poor structure on the way down. Usually poor structure on the way up gets repaired, meaning that the market will fall apart and come down. Poor structure on the way down is indicative that the market wants to turn around and eventually rally and go through that poor structure and repair it. So beyond that, I'm also noticing that when I look at these 2 days together, the value areas, which is where 70% of the futures volume went off in the 2 days, which is the yellow shaded area, obviously, these value areas are not breakaway, meaning that they're not, this value area obviously breaks well away from the prior value areas, which are all the way up here in the consolidation, but Friday's value area doesn't break away from Thursday's. So when a trend is young and this move downwards in the market just started, it would be much more bearish to see the value areas separated and not touching each other, and they're clearly overlapping by a huge margin between Thursday and Friday. So that also I think adds to the sentiment that I'm saying here, that it's bearish, but it's not overly bearish. Beyond that, the overall volume picture in the markets on the New York Stock Exchange was not overly bearish on these 2 days. I'll give you the exact numbers. This Thursday was about 3.2 billion shares traded, and this Friday was 2.95 billion shares traded, which I thought was interesting because Friday was an options expiry, and usually you'll see a pickup in overall volume on that day, and we did not. It was actually came in lower. Now, a lot of you may be thinking, okay, but maybe this is the new normal, and I've thought that myself as well, thinking, well, you know what? Volume's been around 3 billion shares in the NYSE for a long time. Maybe it's time to say, stop saying that it's low volume. Maybe this is the new normal. I'm not going to speculate as to whether or not, tons of shares are now trading in dark pools and it doesn't register on the volume, whatever the reason may or may not be. But there's one thing that would not change, and that's the fact that even though we've been in an environment for a while where 3 billion shares a day has been the norm, if you have heavy selling, such as we had on Thursday, where you break out of a long consolidation pattern, which was like a 7-day balance here, and this head and shoulders, why was there no uptick in volume? Why was the volume basically average? Even with the low volume, when you have big, heavy down days such as here, you'll see well over 4 billion shares change hands. So that is something to think about. Overall volume did not pick up at all on these two moves. Okay. All of that being said, where can this market go? I've drawn in the dominant trend line on the S&P where I think we're going to go. That is at 1607. I also want to put Fibonacci retracement on this move, and I think you'll be pretty interested to see exactly where the 61.8 of this last move up ends up, and voila. No big. This is a nice confluence here right at the trend line. So the 1617 is going to be very key. I don't know that we go that far down, but if we do start to get some heavier selling or just keep meandering lower, this would be an area where I would think the market is a very, very strong buy. Don't forget this trend line could easily move up over time. Therefore, it may move up and meet this 50% retracement, or the 50% retracement could be the target area for the market. So going forward in the next week, everybody should pay very close attention to 1635 roughly, and also this 1617 area right here. That's going to be very, very important. Okay. Other than that, if you look at this move down in the S&P in relation to what's going on in the other majors, it's always important to take a look at Dow, Nasdaq, Russell, etc. Dow is looking pretty bearish. It's really kind of the same pattern. It's rolled over a decent amount. And I did not strike a trend line here on the Dow, but I will do so. I'll put this line here, and again, swing it right up just like I did. So check this out. So now the Dow is actually right at this longer term trend line if you draw it this way. And let's look at comp, which is NASDAQ Composite. And NASDAQ Composite is really not all that bearish at all, because notice the difference between what the head and shoulders pattern in the SPX looks like. Notice that you have the head, left shoulder, head, right shoulder. It's broken all the way down out of it. Same thing in the Dow. And look at what we just looked at in the comp. Where is the NASDAQ Composite closing Thursday and Friday in relation to the pattern? First of all, you don't even have a right shoulder here, but you do have this left shoulder pattern, and notice where price is, well above. So that to me is also indicative of the fact that I would be trusting support in the S&P coming up at some point, because I know that the NASDAQ hasn't completely fallen out of bed and is probably giving me a signal that it still wants to rally at some point. And then that would also tie in perhaps with the S&P coming into those supports. If the NASDAQ is coming into that prior support here of this left side area, maybe at 3574, then that would also make a bounce in the markets that much more powerful. Okay. I am looking at a trade for longer term in the bonds that I briefly touched upon in the Tasty Trade show today, which is talking about long bounce in the bonds, and I'm looking specifically at the ETF TLT. And I haven't put this trade on yet, but I want to share it with you. It's something that I'm looking at. If you look at a monthly chart of TLT, I thought it was interesting that you could strike trend lines here at the lows. And this actually fits perfectly. This is dangling stuff. And look at the perfect touches here, taking you to about 91. And then you also have horizontal support, basically a lot of which is right in this 90 area. And this is not necessarily support, but more kind of a chop zone. And it occurred to me today when I was looking at this that if these are monthly bars, what would happen if in the next 2 months bonds fell out of bed and they fell all the way to this supporting area? How could we capitalize on that in a very low risk fashion? And as you all know, one of my favorite trades to do is a ratio spread. And I was thinking, what if we looked at an October 13, 2013 ratio spread, which is about 60 days out, and we could set something up where we capture perhaps like long puts at the 93. So we could do sell back ratio, and maybe put the short puts at 90. And notice that a 93.90 is trading for essentially even money. It's a 1 cent credit. And if that's not possible for you because of margin, or if you feel it's too risky, well, what if you did it as perhaps a butterfly or a broken wing butterfly? What if you had a 93, 90, 87 butterfly? That's $3 wide in each. And then we could also look at possibly doing a broken wing and making it even cheaper. We could break that 87 outwards and put it maybe at 85 for 4 cents, or down to 84 or actually that trades for 5 cents, but that's because the market's closed, so it's showing some funky prices in here. But you get my point. You could easily just structure the trade in a different fashion that way. So that gives you a couple of different ways to play it. So it's an interesting longer term play. And as I was saying before, it's not all that much risk. Even if you had the ratio spread, you would then really the only thing that makes a ratio spread somewhat dangerous is if price moves too far, too quickly, too early in the cycle. So for instance, in this trade, you've got roughly 63 days for it to play out. If, for instance, in the next couple of weeks, bonds all of a sudden just had some huge crash and moved from 103 down to the where we are now, down to that 90 area, then obviously it would not be favorable for you. What you want is for price to get down there at a slower pace and eventually sometime during the October expiry be in this area. That would obviously be optimum. But even if that was to occur, remember that any ratio spread can be turned into a butterfly simply by buying that bottom leg. So in this case, you would just buy the 87. And also you could structure for relatively cheap money here, as a butterfly, regular or broken wing butterfly. I, of course, like to do the ratio spread. I'm not adverse to the more risk, and I like to basically be able to put the directional trade on for little to no cost, or even better, some sort of small credit, so the market pays me, and that way, even if I'm wrong, I still make a tiny bit out of it, and there's no pain there. All right. Last but not least, I'm going on vacation next week and into the week after for about the next 10 days. This is going to be relatively rare for me in that I will not be blogging or doing any type of trading or ShadowTrader work during that time. The ShadowTrader blog is going to be posted every morning with a picture of the profile in the blog, but I will not be writing the commentary for the next 7 trading days. So the next blog commentary from me is going to be on the 28th. However, there will be a snapshot of the profile and the overnight action posted here into the blog every morning at around 9 a.m. So you will be able to get that, although like I said, there will be no commentary from me until Wednesday the 28th. All right, beyond that, we just finished the Tasty Trade Iron Condor earnings experiment, and I did a full write-up here. If you notice that in blog I clicked categories and educational articles, and here there is a full article that I just wrote on Friday giving details on our Tasty Trade Iron Condor's earnings experiment. Pretty good detail talking about how it went. We were basically selling Iron Condors using the expected market maker move indicator on Thinkorswim. We did these trades live with a very small lot, just a one lot, did them all with real money, and the results of all the adjustments that were made and all the trades are right here in the blog. You can just click on this link here and you can see there's some statistics here, and this is actually a pretty good read. I like the way this came out, so if you have some time, give this a read, and certainly you can shoot me an email at asktheshadow@shadowtrader.net and give your opinion on the whole thing. All right, so on behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.